All right, welcome back. We're going to talk today about business acquisition financing, mostly about SBA 7A financing. There are alternative financing options out there, such as seller financing, such as term loans. Sometimes people get creative and they borrow equity from real estate they own. Lots of ways to structure deals. But typically, most people want to utilize the SBA loan program because it's the most advantageous program where you can borrow up to 90% of the total cost. That includes purchase price plus working capital, inventory, etc. So what do we have to do as we're evaluating these businesses to really see if this deal is eligible for SBA financing? And really, I always tell people the same thing. It really starts with, let's get the financials, get the financials, get the financials. Get 3 years of tax returns from the seller's business. So you need, right now, you would need 2021, 22, 23, and then a year-to-date P&L and a balance sheet from the business that you're looking to acquire. Generally, we'd also want to know what the rough deal terms are going to be of the purchase. If it's a brick and mortar location that you're acquiring and there's a lease component to it, we want to see that the lease with renewals can match the term of the new proposed SBA loan, which would be a 10-year term without real estate. So always keep that in the back of your mind. Sometimes you have to go back and renegotiate with the property owner if it's a brick and mortar type of business. So once we get the financials from the business, we can then spread the financials and we can look to see if the cash flow from the business will support the new SBA loan. And we use something called DSCR. The minimum debt service coverage most banks are going to look for on a business acquisition is 1.15. And that basically is not that much cash flow, really, when you think about it. You really want to buy a business that's got a lot more cash flow that will support a bigger, like a 1.5 debt service coverage ratio. 1.15 is the bare minimum, which doesn't give you much wiggle room unless there's a lot of value add component to that business that you're acquiring. You can also look at doing a combination of SBA financing with seller financing. So let's just take the $1 million total project cost of the business. Let's just say it's $1 million acquisition. Well, 10% is $100,000, so you have to come in with $100,000. You can see if the seller is willing to carry a portion of that $100,000. Let's just call it 5%. So if you can get the seller to carry back 5% on standby, which means no payments due within the first 2 years, or potentially could be an interest-only payment for the first 2 years of the loan, it's almost like they're leaving their equity in the deal. Most times we see it on full standby with no payments made. However, during that time, it can accrue interest at a negotiated interest rate. Generally, most banks like to see at least 5% equity injection. Now, that 5% can come from an equity partner. So that $50,000 could come in from an investor equity partner. It doesn't necessarily have to come from you, and then they could own a certain portion of the business. Anything under 20% of ownership, they don't need to be a guarantor of the loan. Anybody that has a greater ownership of more than 20% needs to guarantee the loan and provide their financials. So as you're structuring your deals, just keep that in mind. So you can get really creative on how to finance these types of deals. You can utilize SBA for partial buyouts where some of the ownership or all the ownership is going to stay on. Now keep in mind, if they retain more than 20% ownership, they will have to guarantee the loan. If they don't, then they don't have to be a guarantor. The other thing to keep in mind is anytime the loan amount's over $500,000 and there's a collateral shortfall. So generally, every single deal that does not have real estate is going to have a collateral shortfall. Loan amounts over $500,000, guidelines state that they have to look for additional collateral. So if you have a primary residence or rental property, assuming it's not in a state that's protected, like Texas, you can't lien a property in Texas because of the Texas equity laws. They're going to put a lien on your property in order to make the loan work. That is per the SBA guidelines. So if your loan amount's over $500,000 and there's a collateral shortfall, just keep in mind that's going to happen. And sometimes they have to take 2 or 3 properties to make up for that collateral shortfall. So if you own a lot of real estate, you do kind of get penalized, because the thing is, if the deal is strong, there's certain banks and lenders that will actually make that loan with no collateral. So there's a lot of banks that do what we call in the industry airball deals, meaning there's no collateral. It might have a $3 or $4 or $5 million collateral shortfall, but yet they're willing to do it because the business is strong, it's been around, and it's cash flowing, and the cash flow supports the new SBA loan from a debt service coverage standpoint. So this all sounds great, right? So what do you need as going to be, let's just say you're going to be the primary borrower, you're only going to be the only guarantor. So they want a resume. Do you have any business experience? What you've done over your career? They also like to know, is the business in a location close to you, or is it far away? Some banks say, hey, we only want to make loans if you're going to reside within a 2-hour, 2.5-hour radius driving time. Not all banks are like that. That's why there's people like me, because I can help you figure out what bank has an appetite for that particular deal. There's different business classes so I have some SBA lenders, and they only would do deals with commercial real estate. They won't do any business acquisitions without collateral, without real estate. So understanding who really does business acquisition with airball deals with no collateral, who does, who doesn't. We generally want to work with a PLP lender. That means they're a preferred lender for SBA. And so they're going to underwrite the deal in-house. The deal doesn't go to SBA, only to get a case number, essentially. So from you, going back to you, so good credit, showing ability to repay, a decent resume that correlates. It does, that is also a very gray area. Now, generally, if you're getting into a business with a higher default rate, like restaurants and things, they usually like to see restaurant experience. But we're always able to, if there's compensating factors to the deal, we can usually get them done. Meaning, like, hey, you've run businesses or you've managed businesses, even if it's in a different class. So I wouldn't be too concerned about that. The other things I would say is look, if like some banks are going to scrutinize if you're getting a big seller carry and they're doing a standby, and you're only coming in with 2.5%. So the most that I've seen banks willing to do, and granted, are there 100% deals done where the seller finances 10%? I'm sure it's happened on a case-by-case basis, but generally, the most aggressive banks are usually saying, okay, we want to see 2.5% at least, and then the seller has a 7.5% on full standby seller carry note. So keep that in mind as you're structuring deals. At the end of the day, it has to make sense. So sometimes there's people that have like no trade lines on their credit, even though their scores are decent, they're 700 scores, but they've never borrowed more than $5,000 on their credit report. So sometimes deals like that will get scrutinized. Deals under 500,000, they generally use the SBSS credit scoring model, and that was a credit scoring model designed specifically for SBA loans. So if you're sub 500, they're going to use a model like that, or that model in particular, to score. And as long as you score there, then you should be fine. So basically, resume, Form 4013, which is a personal financial statement. The bank's going to want to see 3 years of your tax returns, a recent W-2 if applicable. If you own any other businesses, they're generally going to ask for those business tax returns for the past 3 years, a balance sheet and year-to-date P&L, and a debt schedule. Other than that, it's pretty simple. Now, keep in mind, on top of the business having a cash flow from an SBA underwriting standpoint, loan amounts over 250, they're always going to do an external valuation. They're actually going to have an appraisal or business valuation done. So it's got to appraise. They're going to take the lesser of the two. So it's got to at least appraise at the purchase price of the said property. Or then they're going to look at like what it appraises for, and they're going to base their loan on that. So there's lots of ways to structure it. 90% financing is possible with 7.5% on a seller note. So you can close $1 million deal with 25 grand. It gets done. Not all banks will do that, but it is possible if all the other pieces are aligned. The other beautiful thing about SBA financing is it's really the only financing tool that will do such high leverage financing, right? With no collateral sometimes. What can you do to prepare? Because I get calls all the time. I get text messages. Hey, I'm looking at this business. It's been around. It does this much revenue. That is great. But like, do what you have to do to get the tax returns from the business so we can underwrite it from a cash flow perspective, the way it's going to be underwritten by the bank. That is step one. Step two is obviously all these other things I've talked about: Form 413, 3 years of your tax returns, resume, those kind of things. So it's not that paper intensive up front. Generally, from that list I just talked about earlier, we can get you an LOI from the bank, credit union, or non-bank SBA lender we're partnered with. So what do I do in the equation? Great question. I'm really like the quarterback in the beginning. I help get you the package together. I size up the deal. Sometimes once we size it, we realize that there's not enough cash flow. So we go back to the seller and say, hey, here's our proposed structure. Well, this is what you're doing. Look, we're going to do a $500,000 SBA loan. We need $200,000 on full standby, which meaning we're not going to count that in the debt service coverage component of it. So we can help from that standpoint. So if this is your first business, I think starting with the SBA portion of it is wise. And a lot of times I get calls and they're like, hey, they won't give me the financials. The business broker won't give me the financials until I'm pre-approved or until I'm send them a letter that I'm qualified. We can help you with that, but really that letter is really worthless. I mean, because we're on a business acquisition, the weight is really on the business cash flow. Obviously you have to qualify as well, but really if the business doesn't cash flow, there's no deal. Now, there are certain areas where you can make deals work that aren't cash flowing. If it's a value add deal and there's compensating factors, especially when there's real estate involved, then it's oftentimes easier to get deals that aren't cash flowing because they're mismanaged. We can show why they're mismanaged. Obviously, we're doing any add backs we can into cash flow, depreciation, and so forth. So what are some of the red flags? Well, the red flags usually are that you don't have the financials, you have just the P&Ls, and those are not going to correlate to the tax returns. Because remember, it's got to be underwritten. Business acquisitions are underwritten off the seller's business tax returns. So that's number one thing I see all the time. The other things I would say is, good point here. I'm just looking at my notes. Over reliance on a single customer. So if the business you're buying is really like they have like 80% of the revenue comes from one customer, sometimes that is going to be heavily scrutinized. And then a lot of declining revenues is always a troubling sign. Sometimes a good letter of explanation. This is why just this year we had declining revenue. Here's what we're doing about it. So those are things that are going to be heavily scrutinized. Now, they're not just going to go off year to date when they're doing a cash flow analysis. They're going to average the financials. So keep that in mind as well. So they might be pricing the business with their 2023, but 2022 was a lot weaker. They're going to do a blended average. They're not going to just take year to date being the best year ever, so forth, right? So we got to be realistic on that. So that's why I always say vetting the deal with SBA guidelines first will help you as far as the beginning steps of your due diligence. Obviously, you got to dive in. Now, the other pitfall I see sometimes is that a seller is selling one component of a business, or he has several businesses under one tax return. That makes it extremely difficult to finance. Can they be done? Yes. Typically, if they have good P&Ls for that business that they're selling or that division that they're selling, banks will do these deals, but they're oftentimes are going to say, hey, we're willing to look at this deal. We reviewed the financials, so forth. You still need the tax returns from the parent company and the P&Ls. But what they're going to request to, before they give any sort of loan commitment, typically is going to be a third-party quality of earnings report. And that's like a CPA firm that actually does a big audit on the financials and essentially verifies that the numbers correlate to the P&Ls and a little bit more detail beyond that. So those types of deals can be done because I often get pushback. Hey, the seller doesn't want to provide tax returns because it's for other of their businesses. We still are going to require those tax returns. So keep that in mind as well as you're looking at businesses. So The application process, we kind of outlined how to get an LOI. So generally how we help you in the beginning is we're going to have an initial conversation. We're going to get you the needs list, what we talked about earlier. Those documents, we're going to get an LOI, maybe 2 or 3 LOIs. We're definitely going to have several conversations, figure out what the best deal is, what the best leverage, best margin, because most of these loans are Wall Street Journal prime plus a margin equals fully indexed rate, and that's going to be adjusting quarterly. On a business acquisition with no real estate, there's no prepayment penalty. It's a 10-year term, quarterly adjustment based on prime. The margin is the difference, and also, the scrutiny of the file. Some banks are extremely easy to work with. Some of them are going to paper trail you to death. Just understanding, the deal itself, and then what is the best option, and understanding why we're going to this bank or credit union or non-bank SBA loan. Timeline. Most of it's, what I find is a lot of it is on the borrower getting the needed items to get to the closing table, and also oftentimes getting additional items from the seller is what really slows the process down. Generally, business acquisitions, 60, 90 days time frame, and it really is a component of getting the items to the processor at the bank in a timely manner. That's really what I wanted to touch on today. So really, I guess to give you any feedback is like, if you want to be prepared, have a resume, have your Form 413 stored somewhere where you can just update it as you go. And then once you're ready to submit a loan, you can sign it and date it from there. Obviously store it in somewhere secure, and then get the 3 years tax returns, year-to-date profit and loss, balance sheet, and then you can upload that to us. And then we'll come back and hopefully be able to get a term sheet. Maybe we'll have a few more questions. Then you can go ahead and submit your LOI with any of your contingencies that you want built into that. And then once you sign the LOI, typically the bank will take over the processing of the loan. Our team stays with you, but they kind of take over as far as document collection and getting you to a loan commitment. Now, each bank works a little bit different. I have some banks that I can get loan commitments in 10 days. I can usually get a term sheet within 12 to 48 hours, usually pretty quickly, assuming we have the initial paperwork. If you have any additional questions, you can go to bookwithbo.com. But typically, I'm getting people reaching out, and really the first step is if you have these basic requirements, good credit, good outside income that supports your outside debts, a decent resume, then you should be fine on that component, right? And so really the biggest component, like I said from the start, is to get the financials. And that is really how you can do it. And then from there, we can help you structure the deal. Maybe we need some seller financing to make the cash flow work, and so forth. So anyways, you can go to bookwithbo.com if you have any additional questions. I hope this was useful. We have a lot of SBA videos on this channel. Also, we talk about franchises, resales, business acquisition, construction, and many more topics. So hope you enjoyed, and I'll see you on the next episode. If you're looking to grow your business, I put together an ebook. It's all about utilizing virtual team members and AI together to 10x production. If you're looking to grow organically without having a massive team and massive overhead, this ebook's for you. It's free. You can go to bizscalingplaybook.com, get your copy. It's got all the tools I use, some prompts, and much, much more. It's an evergreen book. We'll continue to add to it. Get your copy now before it's too late. Hey guys, Bo Eckstein here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.